My name is David Delaney. I am the CEO of Itafos, and thank you for being here today. This is our disclaimer slide. We'll be talking about a few forward-looking statements. But Itafos is a pure play phosphate company, and there's probably never been a better time to be in the phosphate business. I've been in this industry for over 40 years, and I think what we've witnessed in the last 5 years and where we're going is pretty darn exciting. We have two vertically integrated operations. Our flagship is in Conda, Idaho. We make MAP, which is a fertilizer product, MAP Plus, and superphosphoric acid. So a great operation there, great team, great leadership. And then we restarted our Arraias facility in Brazil 4 years ago. So really two high quality assets in a very good market. In addition, we have two high quality phosphate mine projects. One is in northern Brazil. The other is in Guinea-Bissau, so something that we'll be talking about today. Our goal is to create long-term shareholder value by closing this valuation gap that we have. Our share price is up 800% in the last 5 years, 80% this year, but we still have this gap with our peers and really where we should be. And our path is really built on three pillars. The first is operational excellence. It's imperative really having a flagship operation that operation runs at a 100% operating rate, and the team's done a great job. We have a turnaround every year, then a larger turnaround every 3 years, a team that knows where to spend that money to ensure that we run that operation as full out as we can. And then secondly, we have a long-term MAP agreement with Simplot, which is a competitor, but they take all of our MAP, month in, month out, 30,000 tons a month. We invoice it once a month. It is a CFO's dream, so we have that as well. And then we sell about 30 superphosphoric acid customers across the country. They're annual contracts. They don't vary much from year to year. It's the same people that buy these products in the same quantities. They love our product. We have a high quality product, and that's going extremely well. Secondly, is we're very disciplined with our CapEx and where we invest. Again, we maintain our assets year in and year out. And then we're also proactively investing in increasing our resource. Thank you. Increasing our resources. So we're doing a lot of drilling right now to prove out more mine life. We think we have enough ore in the area. It's a big phosphate belt. They'll take us well into the second half of the century. And then we're also maximizing our foreign assets. As I said, Arraias is a plant that was in care and maintenance until 2021. We restarted our sulfuric acid plant. Brazil was short of sulfuric acid, had a great year. And then in 24, we started selling a direct application rock and a partially acidulated phosphate rock that's been extremely popular in Brazil. We will move 250,000 tons of sulfuric and these phosphate products all by truck this year. I mean, where there's no barges, there's no rail or no ships, and it's amazing the demand for our product. We're inland Brazil, away from the coast. Brazil imports 85% of their phosphate, so anything new and domestic in Brazil is extremely popular. And then high grading our portfolio. We sold our rare earth mine project in Brazil. It closed this year to St. George Mining. For $21 million. We received the first payment this year. The next two payments, one's due this fall, one next year. We also own 10% of that company. The value of that company is up 8x since it started. So again, very disciplined in what we do day in and day out. In terms of utilization, this is just looking at our company compared to our larger peers, Nutrien and Mosaic. Again, running at 100% capability the last 4 years, going on 5 years, in a market that's giving us between $400 and $600 per ton P2O5 margin over these last 5 years. So it's really important to run as hard as you can. Then again, looking at our EBITDA margin, we're much smaller than our bigger competitors, and our margin's actually, above 40% in 2022. And then above 30% overall over that 3-year period. We were in tough shape. If you go back to the 2017 to 2020 period, globally you had low phosphate prices, low crop prices, you had some new capacity that came online, and the genesis of the company was our first asset purchase was the Arraias facility. And we tried to run that thing at full capacity. What we found is the ore is homogeneous across the sites, very low grade ore. But what we've learned in the last 5 years, there are some pockets of really high grade ore that we think will give us over 20 years of mining, selling the products that we have. So we've gone from a lot of debt to basically no debt over a 5-year period. We have great liquidity. We have around $90 million of cash and an $80 million ABL that's undrawn. Our CapEx has been a little bit heavier starting in 23. We had to build out our new Husky One North Dry Ridge mine. We, again, spending money back into the sites. We've got one more project in Idaho called magnesium reduction. The Husky rock is a little higher in mag, so our SPA customers like the lower magnesium, so we're going to spend some money there. We've got to spend some money to close the Rasmussen Valley mine. So through 27, a little higher CapEx, around $100 million a year. After that, the free cash flow will be pretty dramatic as these markets hopefully stay kind of where they are today. Again, this is a look at our multiple at 2.4 compared to CF, Nutrien, Intrepid, and Mosaic. And again, a little bit, I think, is our history. We do have a controlling shareholder, a private equity group. They've been a great partner that's not in a fund that has to be sold. They're hanging with us. Obviously, they would like to get out at some point in the future, but they are not in a rush. They also recognize that capital returns post-27 will be in a much better shape to provide that. In terms of market dynamics, we kind of follow the crop cycle, crop fundamentals. In the U.S., if you look at total acreage, it does not vary that much from year to year. However, this year we planted 98 million acres of corn in the U.S. It's actually the highest since 1936, so an incredible number of acres planted. On top of that, they had a record yield of 187 bushel. So we've had great consumption, I think, across North America and exports, but the carryout's still around 2 billion bushels, so there's a lot of harvest pressure on corn now. Pricing, if you look at the elevator prices across the country, they vary, but up in the Midwest, it's probably closer to $4. We really need probably $4.50 to $5 moving ahead. And right now we're looking at some ad hoc payments. I know the Secretary of Ag came out 2 weeks ago, indicated there could be some tariff money returned to farmers here yet this fall. We'll see if that happens. But part of the big, beautiful bill, and I think the last bill that Biden had, there is more money coming to farmers in 2026, either through better insurance, lower insurance premiums, the ability to get money, and also just ad hoc government payments. So if you go back, I mean, really the last 2 or 3 years for farmers has not been great, but it's been different for us because of the scarcity of phosphate that we're seeing today, not only in North America, but around the world. The stocks to use ratio, you look at that, it's usually between 16 and 18%. The lower it is, the better the crop fundamentals are, the better crop prices are around the globe. There's not a lot of corn outside of China. Most of the corn is in the US. If you go back to 2014 to 2020, the stocks to use ratio was closer to 18%. Through that period, you had low crop prices, you had low fertilizer prices, and right now, that's why I think it's almost a little bit too low, and I see over the next 2 years kind of coming out of this downward ag cycle and probably improving and looking much better. And I'm really bullish over the next 25 years in agriculture, thinking about population growth, middle income growth. It's only going to get better and better, I think, for ag, for farmers, and I think for fertilizer. The other big change, and I don't think people realize what's been happening in Florida. Florida's been kind of the supplier of rock to the world for decades. And right now, if you compare where we are today in Florida to 1990, in 1990 there were 18 phosphate fertilizer companies. Today there are 4. There were 22 facilities. Today there are 10. Capacity was about 11 million tons of P2O5. Today it's running around 5.3. So Florida's gone from supplying the world to just supplying a little bit of the world, as some of the other countries have grown and developed. But what you've got in Florida is really lower grade rock. All the great rock is gone. I mean, there's some okay rock, but it's not terrific in terms of P2O5 content and impurities. It's tougher to process. We're seeing more Peruvian rock exported to Florida right now. We know of one North Florida operation shutting down in 2030. So it's only going to get tougher. And honestly, we just got our permit in Conda. Getting a permit for a phosphate mine in the U.S. is very difficult. It took between the old company that we came from and our company about 10 years and about $33 million of expense to get that permit. So it's not easy. And I think in Florida, with the migration of people to South Florida, there's some ore in DeSoto County that I think needs to get permitted, but I don't think it ever will, just because of the number of people that live there. So, and I think the other big change globally that people aren't aware of is China was a major importer of phosphate forever. And then I would say in the 2010s, 2005 to 2015, they really built up their domestic industry. And so much so they became not an importer, but an exporter, and we're about a third of global trade. So what they have done in the last 3 or 4 years, they were 10 million of a 30 million ton market. In the last couple of years, what they've done is, okay, we only have 25 to 30 years of reserves left. We're going to dedicate more P2O5 to our farmers. We're going to protect our Chinese farmers. We want to be less dependent on the world, which they're still going to have to be. And with the advent of LFP and EV batteries, they're devoting more P2O5 there. So this really took everybody by surprise. Going from a third of trade this year, they will only export 4.5 million tons. So from 10 to 4.5 in a 30 million ton market, there just is not enough P2O5 around the world to make that up. So that's why we have elevated phosphate prices, why we've had them the last 5 years, and why I see this thing going forward and really not getting met. In terms of MAP DAB trade, I just kind of went through the 30 million tons. There are only 2 new plants getting built over the next 5 years, only 2. One is in Saudi Arabia, it comes on in 2028. It's going to take about 3 years to come online at capacity, and one in Morocco. So it's going to be short, I think, for the next 5 years. And then if you look at the next decade, there's really not a lot of new announcements coming out. I think we're 10 million tons short in the next decade at a cost of probably $60 billion. So who's going to build it? Likely Morocco, likely Saudi Arabia. But you've got to have today's prices to justify that spend. So it's going to be kind of touch and go, and I don't really see this thing changing that much. In terms of trade, obviously the Trump effect, all the countries that were exporting phosphate to the US after April stopped. I think we have 2 cargoes coming in this fall, one from Australia, one from Mexico. Mexico is part of the North American agreement. So the market in the US right now going into fall is extremely tight. And I think what is there is going to get used in fall application, even if we see a 20% cutback. So as we go into the winter with basically no inventory, nothing coming in, it's going to be really interesting to see if there's enough phosphate for North American farmers next spring. So that's something that we're watching very closely. In terms of crop exports, I think the big thing we need right now is to deal with China on soybeans. China normally takes US beans from October to January before the Brazilian harvest. We were 40% of their imports in 2015. Now we're 15 to 20%. So obviously President Trump needs to get a deal done with President Xi at their meeting in South Korea coming up real soon. So we're kind of in that period that's got to happen. Corn exports have actually been pretty strong this year without China, about 2.8 billion bushels, so that's pretty good. So I'm less worried about corn, more worried about soybeans right now. In terms of phosphate fertilizer prices, sorry about that. They're very good. And if you go back, I mean, $600 historically is extremely good. We're at almost $800 today. The market's moved down to closer to $700 in the last week or so. But I would say in 2026, CRU has forecasted NOLA MAP prices at $750. Now, I don't know if that's going to happen or not, but my gut is it's going to be probably north of $700. It could dip below, but on average, my guess is there, just because there just isn't enough phosphate in the world, not enough in the US, so we'll see what happens. We buy sulfur and ammonia as input costs. 60% of our sulfur comes in as sulfuric acid from Rio Tinto in Utah. We've got a long-standing relationship. That's a very good contract. That will be ongoing. And then ammonia, we have a long-term contract with our good partner Nutrien that is shipped from Canada into our Conda site. And we think we're competitive with global ammonia delivery prices to other producers. So we think we're in pretty good shape there. In terms of our assets, Conda is situated in mine-friendly Idaho. We own 100% of that site. It's been in operation for over 30 years. It's strategic in terms of that covering that western corn belt, the western half of the US, up into Canada, down to Texas. We're at a great location. We're serviced by the UP Railroad, who's done a great job for us. We're really happy with that. We just are almost complete building out our Husky 1 North Dry Ridge mine. That will take us through 2037. We just had our board at the site in May. We had our board meeting, so the board's been super supportive of all the capital and all the strategic things that we're doing. So really happy with that team in Conda. We got our notice to proceed on May 8th of 2023. It took a while. Believe me, we were starting to sweat at the end, and we had to start cutting trees on I think May 15th. So we finally did get that in the technical report in April of 24. Some of the projects to build this out, we had to build a new haul road, a tipple load out and rail, maintenance shop, warehouses, and then we have a magnesium project going on right now. So we're probably 95% done with that. Our next project, as I mentioned, is mag reduction. That'll start late this year, go through 2027, and once we start the Husky 1 mining, that project will be super useful for our super acid projects. And this is just a look, as I mentioned, really focused on increasing our reserve base, converting leases and to resources to reserves. This is our Conda mine plant. That's where we operate, we produce everything. This is Rass Valley. We're just closing that mine right now. Lanes Creek was prior to that, and then we've been mining North Dry Ridge about the last year and a half. That's going extremely well. And then Husky 1 will be, again, this will take us through 2037. So strategically what we're doing is we're doing a lot of drilling here in Dry Ridge, then Husky 3, Husky 4. It's contiguous to what we're doing today, so hopefully that same infrastructure will work for this. We're hoping this will get us through up to 2050, we'll see. But I will say we got a little more ore out of Rass Valley we're just completing, and I think we'll probably get more ore out of Dry Ridge and Husky 1 as well. So we're doing that, hoping to do an NI 43-101 on this in the next 3 or 4 years to prove out we're past 2037. And then next will be Freeman Ridge and Husky 2. We think there's decades of resources there. We'll convert to reserves. We'll do an NI 43-101 on that, probably in the 2030s. So again, within 10 years, proving out this site can go late into this century, mining and producing phosphate products. This is a great story here. This is Castle Lake bought this out of bankruptcy in late 2016. So this is the genesis of the company, was this SSP plant. And we borrowed some money and we tried to get this thing running with this rock. And what we just found is we couldn't beneficiate 4% rock. It just didn't work. It was costing a lot of money. Then we were very fortunate in 2018 when Nutrien and potash, or when Agrium and potash merged, became Nutrien, they had to divest the Conda site. So that was our salvation to get this company turned around. So we put this thing in care and maintenance in 2019. We thought we're not going to throw any more money at this. We're going to just put it in care and maintenance. And that stayed down for 3 years. But in 2022, the market was extremely tight on sulfuric acid. So we brought our acid plant back up, and I think we sold 130,000 tons of acid that year. And we did okay. I think we basically broke even, but again, it was costing about $5 million in care and maintenance. So from -5 to break even. And then in 2023, 24, we developed these lower grade phosphate products, direct application rock, and then super forte partially acidulated phosphate rock. Then we added granulation this year. So between those three products, we'll move 250,000 tons, as I said earlier, all by truck this year. And we'll make, I think we made $5.5 million the first half of the year. So the second half's going to be really good too. So we're very excited about that team. Again, Brazil imports 85% of their phosphate. So having something inland, we're 300 miles inland. I was down there in June, it was at this Bahia farm show. 2 years ago, these farmers wouldn't give us a time of day, and now they were lined up wanting to talk to us to buy our fertilizer. So we're really excited about that and kind of where this is going. Our next project here will be restarting our beneficiation plant, and we think with the higher grade rock, we're now processing breccia and conglomerate. It's higher grade that we can make SSP. So the goal would be to bring that up in next year and then actually make SSP in 2027. So we're hoping to get the EBITDA there between 15 and 30 million once that all happens. So again, -5, 15 to 30, extremely disciplined CapEx, kind of stage gating all these processes and by year and not overcommitting and allowing that team to succeed. So really proud of that team there. And again, this just shows you the sulfuric acid volumes and the DAPR first half this year will probably be up in this range by year end. And then again, -3.8 in 21. And then we broke even when sulfuric acid restarted, made a little money in 23. 24 made 4.3 first half, 5.4, but you can see where we're going. Again, just being super careful what we do. Brazil's been known for a little bit of bad debt the last couple of years. We get prepaid for everything that we do, so we're extremely careful and not to carry any bad debt in Brazil. They've had a tough time. And again, high grade in our portfolio, the Arraias closed this year, 21 million plus 10% of the company. That's been a home run for us. We were never going to develop a rare earth mine, so to be able to sell it to a group out of Australia, and they're looking to develop that. They've had a ton of interest, and we've seen the value of our 10% go up quite a bit since February of this year. And then Santana is another mine project. It's in northern Brazil. I don't really see that getting developed for a while. There's a lot of infrastructure that has to get built into that area, electrical, roads, just infrastructure, basic things we take for granted in North America. That area has to get developed, but it is some of the highest grade ore in Brazil. So eventually it will get developed, but we like having that in our portfolio just the same. And then Farim is in Guinea-Bissau. That is the highest grade phosphate ore in the world. It's low cadmium, which is important in Europe and some of the other markets. We've done an NI 43-101. So what we're looking at today is it possible for us to develop that asset on a low CapEx basis? And in the NI 43-101, a port has to get built in Guinea-Bissau. What we're thinking today, can you truck it to Senegal, which is the country north, to a port called Ziguinchor? It's probably just as close as if we built a port in Guinea-Bissau. And can we do this on a low CapEx basis? So there's a ton of interest in it from an offtake standpoint, but we know it's in Guinea-Bissau. It's a risky country, obviously. We have a great relationship with I met with the president in Washington in June. They want us to develop that. So we'll be very cautious what we do there. We'd probably like to have a partner, but there is no doubt the offtake, everybody wants it. So we're really excited about the prospects there. Financial results have been really good, going on 5 years. Quarter two, 126 million in revenue, net income of 24, EBITDA was 31.8. Our fertilizer production was up a little bit more in this quarter because we had our longer turnaround last year in that quarter. Another thing we're really proud of is our safety and environmental record has been spotless. We've got a great team. We really pay attention to these numbers day in and day out. And we've got the team company-wide that is so super focused on running a clean and great organization. This is our guidance for 2025. Sales volumes between this level will probably end up in that area. SG&A 17 to 20. The CapEx, maintenance or growth CapEx, right around $100 million again this year, the last couple of years. And I would say 26, 27 will be in that same area of CapEx and ARO cash spend. And then our ARO between $5 and $7 million this year. So again, I think, what the world doesn't see today is how tight phosphate is. You think about demand for copper, where that's going, and AI, and all these different big manufacturer, sites that are getting built. But if you consider our operational and capital and portfolio discipline, how we manage the company, I think investors have seen that phosphate does deserve a multiple that reflects the new global reality of a continued snug market. So those are my comments. Thank you very much.